Mortgages and home equity loans are both borrowing methods that require pledging a home as collateral, or backing, for the debt. This means that the lender can seize the home eventually if you don't keep up with your repayments. While the two loan types share this important similarity, there are also key differences between the two. When people use the term mortgage, they are generally talking about a conventional mortgage, for which a financial institution, such as a bank or credit union, lends money to a borrower to purchase a residence. In most cases, the bank lends as much as 80% of the home's appraised value or the purchase price, whichever is less. The interest rate on a mortgage can be fixed, the same throughout the term of the mortgage, or variable, changing every year. For example, the borrower repays the amount of the loan plus interest over a fixed term. The most common terms are 15 or 30 years. A mortgage calculator can show you the impact of different rates on your monthly payment. A home equity loan is also a mortgage. The main difference between a home equity loan and a traditional mortgage is that you take out a home equity loan after buying and accumulating equity in the property. A mortgage is typically the lending tool that allows a buyer to purchase, finance the property in the first place. As the name implies, a home equity loan is secured, that is, guaranteed by a homeowner's equity in the property, which is the difference between the property's value and the existing mortgage balance. For example, if you owe $150,000 on a home valued at $250,000, you have $100,000 in equity. Assuming that your credit is good and that you otherwise qualify, you can take out an additional loan using that $100,000 as collateral. Like a traditional mortgage, a home equity loan is an installment loan repaid over a fixed term. Different lenders have different standards as to what percentage of a home's equity they are willing to lend, and the borrower's credit rating helps to inform this decision. Special considerations: lenders use the loan-to-value (LTV) ratio to determine how much money an investor can borrow. The LTV ratio is calculated by adding the amount requested as a loan to the amount that the borrower still owes on the house and dividing that figure by the appraised value of the house. The total is the LTV ratio. If a borrower has paid down a good deal of their mortgage, or if the home's value has risen significantly, then the borrower could get a sizable loan. In many cases, a home equity loan is considered a second mortgage. For example, if the borrower already has an existing mortgage on the residence. If the home goes into foreclosure, the lender holding the home equity loan does not get paid until the first mortgage lender is paid. Consequently, the home equity loan lender's risk is greater, which is why these loans typically carry higher interest rates than traditional mortgages. However, not all home equity loans are second mortgages. A borrower who owns their property free and clear may decide to take out a loan against the home's value. In this case, the lender making the home equity loan is considered a first lien holder. These loans may have higher interest rates but lower closing costs. For example, an appraisal might be the only requirement to complete the transaction. Is a home equity loan a second mortgage? Yes, it's a type of second mortgage that allows you to borrow money against the equity that you have in your home. You receive that money as a lump sum. It's also called a second mortgage because you have another loan payment to make on top of your primary mortgage. There are multiple key differences between a home equity loan and a HELOC. In a nutshell, a home equity loan is a fixed, one-time lump sum that is issued and then repaid over time. A HELOC is a revolving line of credit using a home as collateral that can be used and paid off over and over again, similar to a credit card. Does a mortgage or a home equity loan have lower interest rates? A mortgage will have a lower interest rate than a home equity loan or a HELOC, as a mortgage holds the first priority on repayment in the event of a default and is a lower risk to the lender than a home equity loan or a HELOC. If you have an extremely low interest rate on your existing mortgage, you probably should use a home equity loan to borrow the additional funds that you need. But keep in mind that there are limits on its tax deductibility, which include using the money for the purposes of improving your property. If mortgage rates have dropped substantially since you took out your existing mortgage, or if you need the money for purposes unrelated to your home, you should consider full mortgage refinance. If you refinance, you can save on the additional money that you borrow, as traditional mortgages carry lower interest rates than home equity loans, and you may be able to secure a lower rate on the balance that you already owe. We are going to end this video right away. If you have any query or information to share, please leave a comment below. Thanks for watching.